there are those temporary dislocations, and those can happen, several weeks ahead of earnings, and where there's this kind of boundless optimism that may surround a stock. And it doesn't matter how well they did. There was an opportunity to sell into the news, right? That it could be either the company is priced to perfection, they already knew the results were going to beat, or there was a whisper number, or hedge funds who were doing their mosaic theory already knew that there were numbers that were going to suggest that they would outperform and had bid up the stock.
Welcome to the Main Street Meets Wall Street podcast. I'm your host, Marcus Sturdivant, Sr. If you're tired of the noise and looking for a real-world, institutional-grade audit of what is actually moving your money, you're in the right place. Today, we're pulling back the curtain on the 2026 economic landscape, breaking down the volatile data points, identifying where the real wealth is flowing, and mapping out the Main Street agenda for the rest of the year. We have a massive session ahead of us, including a high-level deep dive with Benzinga's own Brad Olsen. We're going to deconstruct how to move from being a passive retail investor to an active institutional level strategist. And I need you to stay until the very end of the episode. Not only are we covering the tactical moves you need for your portfolio, but I'm sharing a specific exclusive link where you can access the professional grade tools that both Brad and I use to conduct these audits every single day. We're giving you the keys to the engine. You just have to be ready to drive. The ledger's open, and we got a lot to get through. Let's get to work. Check out the intro with Brad, and we're going. Welcome to the Main Street Meets Wall Street podcast. I'm your host, Marcus Sturdivant, Sr. Today, we're cutting through the noise. We're navigating an economy defined by more massive infrastructure spending, macro headwinds fueled in the Middle East, momentum that's tested historical valuations, and a ruthless need for operational realignments as companies fight to prove that their AI investments are actually delivering tangible earnings growth. To help us translate these headlines into actionable intelligence, I'm joined by Brad Olson, Chief Content Officer at Benzinga. Brad is seasoned with over 15 years of experience leading editorial teams and growth strategies across the industry's most influential financial brands. From shaping the gold standard intelligence of the Bloomberg terminal to his current role at Benzinga, he has spent his career bridging the gap between professional data and the retail investor. Brad brings a unique perspective, having spent his formative years immersed in the cultural and markets of Eastern Europe, Central Asia, and the Middle East. He doesn't just report on the news, he understands the second-order effects that move the needles for your portfolio in a volatile world. Brad, let's get right into it. We're seeing a massive trillion-dollar AI build-out, yet the market is increasingly skeptical about monetization. When you look at this current rally, are you seeing genuine operational realignment that justifies these valuations, or just high frequency momentum masking up deeper macro fragility?
Yeah, Marcus, first of all, thanks for having me. And these are very, very tough questions that I think the whole market is wrestling and grappling with, frankly. We saw just today and earlier this week, Dell's earnings kind of exemplify how far reaching some of this AI build out is going at the moment. Yeah, at first, in the earlier stages of all of this AI investment, you had these circular financing deals where all these different AI companies would sign a commitment for power usage or chips or compute, and then they would turn around and they'd sign another deal with a similar company, and it was back and forth, and no one really understood, how these agreements were actually going to translate into financial results. And now we're seeing the downstream effects of that from all the picks and shovels plays, be it the NVIDIAs of the world, although you could argue they're not the picks and shovels. They are one of the main beneficiaries of the secular trend, and all the way up to Dell. And then now we see some analytical thought that says that all of this build out's going to have a ripple through inflation too, when it comes to construction jobs in all these different locations. You're talking about electrical engineering demand and so on and so forth. So to some extent, will these companies get the ROI that they want? That's to be seen. You're seeing token prices slowly increase at some of these AI companies. Notably, you had some larger companies blow through their AI spend with only the first quarter of 2026 after budgeting billions of dollars in spend on AI compute. So it's still TBD. I think we're still in the earliest stages, but clearly you look at the Anthropic commitments with SpaceX. They're willing to spend a billion and a quarter per month. There's clear money that's following a lot of this, and so it's only a matter of time till the profitability comes. And I always look at the Uber and Lyft model, where VC massively subsidize the cost for all the consumers, and over time, you now have Uber and Lyft who are making lots of money now because the prices have finally caught up with this with demand. So I believe that these companies will see the fruits of these labor very soon. But obviously, with these very, very large numbers being thrown around, it's very hard to feel super comfortable that the money is going to be returned at a healthy return.
That's a great explanation. I'm glad you hopped on with us, breaking it down just from 50,000 feet. You were mentioning circular investments is one thing. Do you think the circular investments are over with, where like people are invested in one company, it seems to always come back to NVIDIA? So I definitely look at NVIDIA as a picks and shovel, because everything's built off of NVIDIA, even though they're not physically building the data centers or things. And that way, they are building chips, kind of like Taiwan Semi. I kind of send them like a baseline. I haven't heard circular investment in a while. You were the first person I've heard speak of it in a while. Are you hearing that less in the markets now?
Yeah, I think so. This was at the earlier stages, these circular financing agreements, whether it was Microsoft investing in OpenAI and then OpenAI turning around and committing to another business. That used to be kind of a trope, some sort of comedic punchline for a lot of the Wall Street pundits for a while. But I think as things start to shake out, there's going to be real money to be made as these companies start to invest on their own, right? We're seeing some developments now where, rather than leaning entirely on NVIDIA, many of these large companies are going to go out and start building their own chips. So I think it was just a matter of forming strategic partnerships when there was a lot of unknown. And I think it was more about just sticking your stake in the ground early, just to avoid this moment passing you by.
We're going to come back to this in just a second, but you made a really good point when you were talking about um, companies needing to diverge outside of maybe NVIDIA as they needed capacity, they couldn't reach it. We see companies like Micron right now who are just going parabolic with demands for storage and supply. With that whole thesis, I want to jump. You've seen a lot of global. You've lived in different places around the world. In my opinion, I feel like America has kind of forced the world to rebalance the way their strategic partnerships, kind of like we were talking about with the circular investments. What are you seeing and hearing over there at your outlet, that as far as that goes? Are you seeing results to people rebalancing outside the USA, sovereign nations as well?
So it's interesting. We're talking about whether you, as an investor, you want to be invested in U.S. equities or global equities. It's been a constant refrain in the 20 plus years that I've been in this career, where there's always this idea that you need to be invested internationally to balance some of the returns that you might see in the US based companies. Especially in the past several years, that hasn't panned out very well. Yes, sure, you're seeing Taiwan Semi definitely capture the hearts and minds of a lot of new investors over the past year or so. But I still think, by and large, the U.S. is kind of at the front end. It's definitely the deepest capital markets that there are. There's deep liquidity. If you want to have any sort of investable opportunity, this is the place to be. We have at Benzinga, we have a lot of different partnerships that we're forming overseas, especially in Asia. By and large, the information that we hear from brokerage platforms and otherwise is that investors want to have access to U.S.-based companies, the U.S. capital markets. And so, yes, there are a few of these players that have that global reach that are very interesting to some of our U.S. audience. But I think still the fact that OpenAI, SpaceX, Anthropic, Microsoft, Alphabet, all of these players are still U.S. based, and that's basically where all of this is happening. Now, is that to say that China is not a place to watch between the DeepSeek models that came out and all of the efforts they're making? I think there was a recent headline just a couple of days ago about restricting some of their citizens from leaving the country who happen to work in sensitive industries like AI, broadening that restriction from that used to exist around government individuals is now extending to the private sector. Definitely China is going to be at the forefront of a lot of this AI innovation, but I think by and large it's still a U.S. centric opportunity. There's a lot of money sloshing around, as you saw with the Anthropic, the recent raise for Anthropic with a valuation of close to $1 trillion. And obviously the SpaceX IPO, which is very well covered by our outlet and many others, and is very highly anticipated. And all those are still U.S. focused businesses.
There is a lot of push with the USA. There was a U.S. exceptionalism trade, quote unquote, air quotes for anyone listening, that actually did run really strong until like the last year when international definitely flipped and outperformed. I think the U.S. may have taken the lead back here recently.
Yes, I think, yeah.
But, and that's the thing.
Yeah, there was that weird period. Yeah, there was that period recently where international did kind of take the lead.
But you mentioned how portfolios are constructed. And for our listeners or viewers who don't know, it's based on modern portfolio theory, which goes way back to like the 60s. The guy who created it won a Nobel Peace Prize for, well, not Peace Prize, he won a Nobel Prize for the theory, right? So folks listen, so it's based on back in the day, these nations weren't correlated. And part of that was, speed of information, like everything couldn't move as quickly. Diversification, right? We had countries being rebuilt by the US dollar at this time that people didn't realize from the war. But so modern portfolio theory is just basically that when the US is up, Europe will be down. But eventually, US will be up, Europe will be down. It will make an up to the right curve. In 99, that's when you saw it break. You said it's been for a few years, yeah, like 25 years. That's where it broke, and it's just not been the same. The US has just been outperforming, except for a section like just a few minutes ago, where you mentioned like last year, it pops out. Speaking of things that just pop up every few years and seem to take the lead, and we're talking about things that are actually leading the market, small caps. What do you see with small caps? Because they're leading the markets right now. You're listening to the Main Street Meets Wall Street podcast. We've been breaking down market data with Brad Olson. But remember, data without strategy is just noise. If you're tired of being a spectator in your own financial life, it's time to move from theory to execution. Stay with us as we shift from the macro trends to the specific moves you need to make on your ledger today. Also a reminder, this is not personalized financial advice nor stock recommendations. We're going to dive deep today on the forces moving the market. Insights like these are exactly why I started this podcast and this YouTube channel. The Wall Street South Journal as well, to bridge the gap between the trading floor and your kitchen table. We're going to get back to the conversation with Brad in just a moment. First, a quick note on how you can gain some of the same professional edge that the institutions are using. Like I said, strategy is only as good as the tools you use to execute it. In this market, this fast-moving, waiting for the evening news to tell you what happened is a losing game. You need real-time data. Check out Benzinga Pro. Talk about how it can help level up your toolkit. It's part of what Brad does. We'll get back to it soon. Back to our conversation with Brad, and if small caps can continue to grow.
Yeah, it's funny. Several years ago at Bloomberg, I was writing a column, and there was one particular reader who kept writing into me and saying, we're talking a lot about the S&P 500 or SPY. You should really start to pay attention to the equal weighted ETF, the S&P ETF, and I think that always keeps coming back to my mind, especially as we talk about market concentration. These top names, these multi-trillion-dollar companies like Apple and Alphabet and Microsoft and Nvidia, it's only a matter of time until the pendulum starts to swing back and the concentration is lessened. I don't have a strong opinion about the small caps. I think it's just the trend may have gone a little bit too far, too fast. You still have, we all remember in the first administration, 2016, that the America First idea was a very heavily focused platform that tended to benefit small caps the most. There was this idea that money would stay within the country. These smaller companies would benefit. These companies that have a high concentration of businesses in the U.S. A lot of people tend to forget. Oh, I'm buying McDonald's stock. I'm buying Nike stock. I'm buying all of these American brands, so they make all their money in America, but they don't, right? A large portion of their revenue and their profit, frankly, is derived overseas. And so when you think about either the fiscal policy or monetary policy of the U.S. and to the extent that it's going to benefit, whether it's in the tax code or in contracts or other policies, the small caps are going to be bigger beneficiaries because they're more heavily concentrated in the U.S. and in their ultimate businesses. So, in terms of their recent upswing, I don't have a strong opinion on it one way or the other. I think it's just over time, this idea, the saturation of money in these very, very large names, people tend to get a little bit of a cold feet buying into a company with several $1 trillion valuation. There are definitely very sophisticated actors within this marketplace, and they can determine whether they want to buy a company at 50 times earnings or more. And I'm going to let them kind of do that math. I know that the average bystander, if you're trying to figure out whether you want to buy a value name or a growth name, it's pretty hard to think, is this worth 3.3 trillion today and it's worth 3.8 trillion tomorrow? Is it really worth that when that's a swing of 500 billion, like a billion here, a billion there, and sooner, then at a certain point, that's some real money. So I think these big numbers are making it a little hard for everyone to kind of contemplate whether these companies are truly worth what the market is saying they're worth. But, don't fight the market, as they say.
Don't fight the market. Yeah, and it's been like some irrational exuberance. I heard that word thrown around a little bit more, but even when that was first said back in what was that, like 96 by Greenspan, the market still ran for like 3 more years. So we're definitely giving people, this is one thing we want to sit back and take a second for people to realize, like, we're trying to give them information. We're not telling you to go invest or not invest time in the market, though I will tell you that. Don't try to hop in time in the market, but we're trying to give you information so you can figure out how to make a more informed decision, right? Brad's all about delivering alpha over there, and we'll talk about some of what you do over there at Benzinga, as well as your history at Bloomberg before. But fresh off the presses, I heard Secretary Besant speaking, or I heard some sound bites where he said, the Fed's going to get back to the basics. They have 100% approval for removing forward guidance. How do you think the global community is viewing our Federal Reserve right now? Because the American Federal Reserve pretty much controls global interest rates, in my opinion. Like, Japan sets the floor for lowest pretty much, but America controls it.
Yeah, I think recently we all talked about how the central banks are supposed to be independent. Many of them are independent. There are some countries that there's less of a line between the political parties that run the business, run the country and their central banks. I'm not going to name any names. You can look it up yourself. But those types of things are wearing, we're getting very, very close to that line in the U.S. I'm not casting aspersions. It's just when there is frequent commentary about the central bank coming from political figures that should, I think it's not crazy to say that that's kind of a concerning thing, only because it's a departure from the norm. Whether that's a good or a bad thing, that's up for the markets to decide, not myself. But it is a different way of doing things. And what we're noticing politically is, look, there were these norms in the post-World War II era. The U.S., Europe, and the U.K. were very, very closely tied. And now you're seeing rumblings within the European Union about not relying on the U.S. for the same types of support that they may have, relied on in the past. And this idea that they don't necessarily have to look to the U.S. to emulate any of the things that they are doing. And so even if the Fed stops with the forward guidance, I don't really expect some of the other countries in Europe to, like the ECB, the European Central Bank, I don't expect them to necessarily alter any of their policies, nor the BOE or the Bank of Japan. I think they've understood that the way of doing business with the U.S. has changed, and they have to forge their own path. Are the markets happy with forward guidance? Nothing's set in stone yet. I think we're going to have to wait to see it before the market can react. But I definitely saw the criticism around why are these different central bankers showing exactly where they think things are going to be, only to be proven wrong several months later. Where's the value in that? I know when those dot plots were originally put together, it was out of a need of transparency. The market wanted to know exactly where things were going. And I think that's a common phrase and refrain that we hear a lot, is that the market doesn't like uncertainty. And so the more information the market can absorb and contain, the better. When you don't have that kind of transparency or information, then that's when excessive volatility tends to occur.
Excessive volatility is where some of the biggest gains are made in stock markets, but
Absolutely.
Hence why you have to stay invested in the market. What are your thoughts, digging a little bit deeper into that? We're talking about central banks and their guidance. What are your thoughts on the SEC's move to reduce the amount of time from quarterly reporting for
This is a good one. This is a sticky one for the financial media world too. Obviously, Reg FD, it was huge for not only transparency in markets, for companies to be obliged to disclose material events that are happening within their company, whether that's a departure of a key executive or a particular lawsuit that they might have to settle that might have some sort of material adverse impact or positive impact to their business. And quarterly reporting, in my view, but this could just be biased and anchored in the role that I have in financial media, I think it's important. If you think about 6 months, 6 months is a long time, right? If we move from quarterly to this kind of semi-yearly or even annual disclosure, it's a long time. A lot of things can change in a year. If we want to use AI as an example, just think back 6 months. What happened 6 months ago in AI? You had Anthropic, and look, Anthropic's a private company, and they don't have to disclose any information that they don't need to. But imagine taking a company that was in a similar trajectory as Anthropic. In a span of 3 to 4 months, they went from a $9 billion revenue run rate to $44 billion. And that kind of movement in a short span of time without disclosure is rather interesting, and I don't think it's necessarily helpful for investors. I know the concern, and that's for the burdens that it puts on certain companies, and then also I think even Warren Buffett and others have been very vocal about short-termism and how the quarterly reporting cycle drives companies to make decisions that may not necessarily be in the long-term interest of a business. However, there are key examples of very, very well-established businesses that have had that long-term view, Berkshire Hathaway being one of them, where they've ignored the need to want to beat every single quarter and to make short-term decisions to juice gains. I think when a company does that, there are more concerns that you should be worried about. When they feel they have to do that, you should probably be digging more under the surface about that company itself and whether they're taking the long-term view. So, my personal view is a little biased. I think that more disclosure is better. It provides a better narrative. It gives people more information about what's going on. There are more opportunities for companies to talk. And look, the proposal that's out there right now allows companies to do what they want, right? It doesn't oblige them to no longer report quarterly, as far as I understand it, and I could be wrong there. But my guess is that some companies are probably going to choose to pull back the curtain. I don't know if that's I think it's the other way. They're going to pull the curtain in front of their results. pull the curtain the other way. And
Pull down the curtain.
yeah, pull down the curtain. And I think for retail investors, that's less information. They don't get access to the countless investor conferences and other kinds of non-public exposure to executive commentary and financial results that other more sophisticated investors get. So my view is Reg FD was a win. I think giving investors more information is better, especially with AI now. The ability to translate a ton of new information is helpful. And I think more information is probably better.
Transparency helps. Like we said, like I was saying earlier, like that was part of the reason why modern portfolio theory was working. Like the information wasn't getting across to other people as quickly, so they couldn't exactly move or make moves. There were people, the velocity and speed at which we trade in this world nowadays, like 0-day options, like it's just insane. People don't have a long-term mindset. Like going past quarterly, some people will go crazy, as you said, like the retail investor. What are you seeing with the retail investor? I've been making the case now that like 2025 was the year of the retail investor, whether anyone wants to admit it or not. Like that was the retail investor came in and bought the dips, and they continue to buy the dips when institutional money has come back in buying dips in this year, right? And they started to buy it towards the end of last year. What are you seeing with retail investors right now? You think they're still strong, or are they pretty much exhausted?
I wouldn't say they're exhausted by any stretch. I think there's so much opportunity in different stocks, right? That people don't normally think about. Uranium and nuclear stocks are obviously hot for the power story that, we talked about the picks and shovels and AI earlier in the show. Nuclear stocks are of note. You have the space stocks that are also capturing everyone's attention, quantum stocks. All of these are great stocks that people really weren't paying attention to several years ago, and now are for better or for worse, right? There are definitely there's some dogs with fleas, as Gordon Gekko would say, and you need to do a lot of due diligence when it comes to some of these smaller names that may not have a strong pedigree or track record. Obviously not casting aspersions about any of these groups, but where there's opportunity, there are always people who are looking to capture that opportunity, whether a company has renamed itself in a new vein, it was doing something else entirely 3 months ago and is capitalizing on the new zeitgeist. That's
Birds.
something to always be aware of. They could very well be successful doing the new thing that they want to do. And, I guess one of the more famous examples in recent memory is Allbirds, right? Allbirds is the sneaker company that now is an AI company. But that they're not the only ones and they may have a really good business idea for taking that IP cash and reinvesting it. You had a long line of companies in cannabis and in blockchain and otherwise who rebranded based upon new opportunities. So that would be the only concern, is just do your due diligence as an investor. But as far as our readership is concerned, they can't get enough about what's happening in AI. That's where there's opportunity in the markets. And we could talk about how $0 commissions is helping, and fractional investing is really clearing the pathway. You don't have to worry about that high cost stock. If you only want to buy $50 of a stock, you can, as you said earlier in the call, stay invested. That's probably one of the most important things that you can learn. But stay invested in stocks that you understand, I think is another key principle. Either you want to be buying an index that is trustworthy and has a track record, or you want to be broadly invested, but make sure that you don't, like you said, try to time the market. We talked about YOLO trading, and at Benzinga, we were definitely part of the GameStop saga and AMC back well into COVID, and we were part of chronicling that story, and a lot of our readers were really enjoying it. But right now, from my vantage point, people want to know about where that next opportunity is, and so we're doing our best to chronicle that.
Perfect. Yeah. And that's actually a great lead. So you mentioned Gordon Gekko, Action Dale podcast episode last week, where I started on the More economy, and started with the Gordon Gekko speech where he said greed is good. And then he explained why greed is good. And I was saying, people, that was 1987. And the people who run the country now were like some of them were like in college, or some of them, that was the environment of the world. So we're back into that environment now where like irrational exuberance, people want more. They want more. They want more. Like you mentioned, though, you said the GameStop move and you covered the whole meme trade move back then. Can you take us back through that from back then to like even right now, the latest you're hearing on Ryan Cohen and the eBay thing? I think Cohen may be trying to play chess. People told me I was crazy with the whole move and I know I can unpack this question a little bit more because it's long, but I know when he was on the interview, which I think most people seen, where he just kept saying, read the website, half cash, half stock. And then they asked him, they said, what if eBay made an offer for you? You think he's trying to get eBay to buy them? Hey, thanks for hanging out so far with my conversation with Brad Olson from Benzinga. We've been breaking down some critical market moves today, and honestly, this conversation is exactly why I'm so excited about this upcoming collaboration with Benzinga. When you're trying to navigate a market that's changing by the second, you can't just rely on headlines for yesterday. You need the same real-time intelligence that the pros are using. Brad's influential in putting this content out. So that's why I partnered with Benzinga. And if you've been following the Main Street agenda, you know I don't believe in guessing. I believe in auditing the data. So you should check out Benzinga Pro. Check it every single day to see if you get that institutional edge. Whether it's tracking insider movement or getting news before it hits the mainstream, it's the tool that helps me stay ahead of the curve. Now, full disclosure, the link in the show notes below is an affiliate link. If you decide to level up your tool and sign up through the link, I may receive a commission at no extra cost to you. And Benzinga is at the top of the list for market research. It helps support the channel, the Main Street mission, and keeps the audit running. So I appreciate the support. If you're ready to move from speculating to strategizing, use that link, get set up, and let's get to work. Now, we're going to jump right back into this deep dive with Brad as we see his thoughts on this exuberantly irrational market.
I'm not sure. I saw that interview. I think what is more interesting about that interview is that he did two interviews. He did one interview on CNBC, and then he did another interview on a different outlet, and he had a completely different countenance to that whole interview. One was lighthearted. One of them was a little more skeptical, cynical. I don't know how you want to call it. I do think there's a little bit of gamesmanship going on there. I don't know if it's checkers necessarily, but there is definitely some gamesmanship. I think he really understands, and I think there's been one idea that he wanted to galvanize the retail community to help drive the value higher, which would then allow that process to unfold. Similar to any sort of story stock, right? If you can even use Tesla as one of the original story stocks. You have a very strong figure at the helm who tells a great story, who is always in the public, trying to provide his vision for the business. He has a strong group of people who are they're on top of every word. They're willing to buy the stock. And guess what that allows Tesla to do? They can go out into the market. They can raise capital extremely cheaply. And is it any wonder that they can go out and raise $5 billion at next to zero cost on the valuation of their business, while their competitors like Ford and GM and others are still saddled with traditional forms of debt. They don't have any sort of room for dilution of their investor base, and it's harder for them to compete given the cost of capital. So I think if you can galvanize the base, if you can tell the story, and that can drive the value of your business up, that gives you a war chest to go out and make a splash and do the things that you want to do. So whether it's a reverse psychology of wanting eBay to buy them, or whether it's trying to galvanize the base to drive up the stock to allow them to better afford that acquisition, I'm not sure. I actually don't think it's a terrible idea, those two companies getting together. I think there's been some criticism that I've seen about why they would even get together in the first place. I don't think that's a terrible idea for both of those businesses. But, in terms of his plan for the future of those two businesses, I guess I'll let the analysts duke it out on whether that's the right idea or not.
Why do you think that's not a bad idea?
I think where GameStop has been and where it can go, the memorabilia push, having those retail stores available for people to visit, trading, collectibles, all of those, that whole area has really done extremely well. You can even look at the success of a Netflix show. What is it? The King of Collectibles. All sorts of memorabilia has performed exceptionally well as an alternative asset class, especially at the high end, whether it's Pokemon cards or otherwise. And so I think having GameStop move into that area, whether it's video games and memorabilia, having that overlap with eBay as like the front retail store, this is my ignorant view of both of those companies. I bet they're much more sophisticated than that, but I don't necessarily hate the idea of a tie up there.
That's the thing. Like, companies need to be able to have their investors understand their company, like you said, understand what you're investing in at the simplest level. And you just broke it down like kind of how like eBay and GameStop, where you see the synergy. eBay stock was not doing bad, for the record, when Cohen came in and made this statement.
No, not at all. And that's the interesting part of that, right? Is usually you'll see some sort of takeover offer or even sometimes you'll see a take under offer around businesses that aren't doing well. But yeah, it didn't look like eBay was hurting for it. And by the way, I'm not advocating to buy any one of these stocks. I don't think anything or any stocks, period.
But yeah, no advocation for any stocks. This is just general conversation.
Exactly. Anyway. But again, just on the surface, I wouldn't put it past him that there's some good ideas back there.
Got you. Yeah, and speaking of stocks, we're about to mention another stock. And you were talking about with Anthropic, if people could see the run rate and what it would look like if it was a public company, Intel. Is that not kind of what you just saw? Like with what happened with Intel, even going back 6 months, and you mentioned the guidance, right? So with these AI booms, 6 months ago, when companies were reporting, they would have strong reports and their stock price would go down. Last quarter, we saw companies report and some of them were rewarded, like Intel, which is parabolic. That's got to be some meme stuff in there, right? And then Dell today.
Yeah, I think, underscores the need for transparency. Dell blew away every analyst by far. They blew away their own guidance by far. And that was only 3 months ago. So big fan. I think we need to continue the disclosure processes. Imagine if this lasted 3 more months. The only people who would know this was happening would be the executives and the people who knew inside the company, and maybe a limited set of investors. And so I think important for the rest of the world to see this and have their opportunity. In terms of stocks that have risen on poor results and fallen on good results, there was an old trope and it's not anything that we made up at Bloomberg, but one of my technology reporters back in the day, we would always joke. We would just call it P2P, and we'd say price to perfection. So there were companies that would just, it was so telegraphed that they were going to do well. And one would argue, well, if it was telegraphed that they would do well, why didn't the analysts catch up to to those expectations? Well, sometimes the market can get ahead of those very, very quickly, and sometimes they ignore analysts' expectations for just a short period of time. Now, you talk to analysts themselves, they'll say stocks always follow earnings, right? Don't worry about the stock price, just worry about earnings, and stock prices will follow those earnings. But there are those temporary dislocations, and those can happen, several weeks ahead of earnings, where there's this kind of boundless optimism that may surround a stock, and it doesn't matter how well they did. There was an opportunity to sell into the news, right? That it could be either the company is priced to perfection, they already knew the results were going to beat, or there was a whisper number, or hedge funds who were doing their mosaic theory already knew that there were numbers that were going to suggest that they would outperform and had bid up the stock. But there's also stocks that have done extremely well over the past year, and this is an opportunity to sell into that report, right? You have to think about a market is not just some abstract theory. It's people that are trading against one another, and there's going to be a large set of people on one side who want to exit a position, but they can't exit a position without a similar number of people or market makers taking the other side of that position. And so you want to make sure, in many cases, there are these market dynamics that play a part in stock prices rather than just, is it good, it goes up, is it bad, it goes down.
Right. For every dollar every dollar has a party. Like $1 goes to another person. Like we can't create money. We can, but it would be bad. Like the
Right.
money you already have.
And
Like
we do create a little bit of money each year.
yeah,
Just a little
arbitrage.
bit of
Like I
inflation.
got you. We're saying the alpha
Yeah.
and delta. Jumping into that, because that's what you do over, right? Benzinga, that's what you do over here. Take our listeners, I want you to take your time and just take them back to when you were at Bloomberg. Just tell us a little bit about you. Like everyone may not know you, Brad, but they should definitely listen because you have a different perspective. So take a few minutes and just tell us about you, like how you got into this industry.
Yeah, so I mean, I'm trying to use my little quick elevator pitch here because it's hard to
Take your time.
compress 20 plus years into a short sound bite. But most of my career's been around trading and investing, and media is something that I've embraced over time. I started in media providing services to hedge fund clients and retail investors who were curious about how to trade, quite literally trade the news that they were seeing. And that kind of led into a natural fit at Bloomberg, where the team that I, happened to work with we were tasked with trying to provide that immediate color. When there's a piece of information that comes out, why is the stock doing what it's doing? What did Wall Street think about that stock leading into that piece of news and otherwise? And we had an opportunity to be at the forefront of short form content before that was really commonplace. There were many people will think of traditional financial media as these long-winded, maybe 700, 800 word articles about some XYZ company that launched a new product, or maybe it's a long-winded piece around their earnings. But our job was tasked with trying to break down very, very quickly and succinctly why someone needs to care about what's happening in a particular stock. And our goal was both analytical and journalistic. We would be talking with investors on the buy side. We'd be talking with sell side analysts. We'd be on the receiving end of a lot of their notes and information and their views on the stock. And then we'd also be using our own tools at our disposal to track at scale, how stocks were behaving, whether it was volume or volatility or investor ownership. All of those things kind of bled together to help us tell a strong story about each individual stock. And then ever since then, I've had the opportunity to lead a couple different organizations, and where the goal has been to just truly qualify what is happening in the market at any given time. And you may look at your brokerage app and see, think you may be a genius and said, "Hey, wow, I'm up 5-6% today." And then you may not know why. But part of what our job is to do at Benzinga is to tell people, okay, but within that portfolio, you had 2 or 3 names that outperformed, and they outperformed for these reasons. And by the way, you may want to take a look at some of these other stocks that might have some sort of knock-on impact that you may want to be aware of. So those second order effects, the second derivative of what might be happening, we talk about the picks and shovels at the top of the show, all those interconnected relationships between ETFs, sector-wide moves, even though there might be a piece of news around one particular space stock, even that other space stock that may or may not have some questionable origins, that might benefit from that same type of piece of news. And it's our job to help qualify what's going on and help people either construct their portfolios if there's a little bit of self-directed element there, or at least make them more informed about what it is that they want to do with their portfolio, whether it's dividend investing. You can be a REIT investor. You could try to YOLO some of your portfolio as well in space stocks and nuclear, or you can go for that solid return. And we'll talk about that too, between our personal finance content and markets content.
Very cool. Very cool. And so that's a very cool story. Been doing this for 20 something years. So you've seen several bubbles and several moves and several pops. And now we're talking about the current bubble, the AI quote unquote bubble. First of all, do you think AI is a bubble?
I think, and I'm happy that we're having this conversation this week, where the CEOs of the very AI companies that swore that there would be doom and gloom imminently have walked back some of their statements.
That was great. I want to talk to you about the institutional edge. Most retail investors are operating with a massive disadvantage. They're getting the news after it's already priced into the market. If you're serious about building wealth, you cannot afford to be a passive consumer of information. You need to be an active strategist and consumer of information. That's why you should check out Benzinga Pro. Whether you're looking at small cap movement, tracking institutional or insider trades, or just need a news feed that doesn't bury the lead, Benzinga Pro gives you the same kind of real-time insight that financial professionals use every single day when they're checking their own ledgers. And remember, Main Street meets Wall Street. We're not guessing. We're using data. Benzinga Pro is where that data lives. They've got a workspace designed to save you time and, more importantly, to help you take charge of your financial ventures. If you want to move from guessing to knowing, I've made it easy. You can check out Benzinga Pro and start your journey towards institutional level analysis by clicking the link in the show notes below. Use the link to support Main Street meets Wall Street movement, and more importantly, start giving yourself the advantage the professionals have and that you deserve. Main Street Heart meets Wall Street Smarts. Also, if you do use the link, I may receive a commission. No extra charge to you. Main Street Heart, Wall Street Smarts.